Hello there, and welcome to the College Investor Audio Show. We are so honored that you're here with us today as we take a look at this. So, with the whole Grad PLUS and the student loans and all the stuff going on with the Department of Education, we talk about why private lenders may not be able to replace Grad PLUS. Before we get to it, anytime we have any topic on the podcast that you want more information on, you can always find the article associated with it at thecollegeinvestor.com. Just type in the words in the podcast. You'll find the article, dive deep. We got all the resources, all the links that you need to find out everything you could possibly want to know about every single topic we talk about. Also, you can ask us questions, get to know us. We'd love to get to know you and help you along in your money journey, wherever you are on that journey, at The College Investor. Search for those words and you're going to find us. Okay, so starting in 2026, Grad PLUS loans are ending, and there will be new borrowing options for graduate and professional education. The new borrowing limits, $20,500 annually for grad students and $50,000 for students in designated professional programs. There are definitions for what professional program means and all that stuff. We went over that in a previous podcast. You can see it at thecollegeinvestor.com. Okay, so that represents a sharp break from the prior model that allowed borrowing up to the full cost of attendance, which could be six figures in some instances. The line between graduate and professional is now tied in detailed federal definitions and CIP codes, like I mentioned. It's all inside this article. Placing programs like physical therapy, occupational therapy, physician assistant studies, speech language pathology, and social work under the lower grad limit despite tuition that often exceeds $40,000 a year. As these changes take effect, a second shift is underway. Private lenders are not ready to replace what Grad PLUS once provided. The hesitation is rooted in uncertainty about risk, credit, and behavioral response of students and institutions. Lenders face a market they cannot yet model. So, yeah, we spoke with several private lenders about this, all about the changes that are coming next year. The most consistent message from lenders weighing new graduate loan products is simple. They do not have data. End quote. Under the current system, schools can see how much their students borrow, but have no visibility into their credit scores, income, or other indicators of financial health. Lenders, in turn, receive no track record of how students from particular programs historically perform because the federal government shouldered all of the risk, nearly all of the risk, for graduate borrowers. Okay, there is some data for sure, but it's just hard to build it into a model for every single program. Instead of federal underwriting, lenders will need to forecast repayment outcomes program by program. But without prior years of data, any early projections are just guesswork. The result is widespread caution, and none of the lenders we spoke to appear ready to offer broad, open-ended loans for grad programs. Many of them, though, are exploring cosigner requirements for sure, which may vary not only by school but by program. Program-specific pricing, reflecting the earnings potential and attrition risk of each degree, whether to count income from assistantships, which helps some borrowers but is viewed as unreliable and kind of temporary, and also risk sharing, with schools absorbing part of the default or non-payment risk. That's a great idea. However, lenders stress that the need for risk sharing may differ across programs within the same institution, and schools generally don't want this. Of course not. But the lack of borrower credit data combined with program outcome data shapes all of these choices. Until lenders understand who applies, who qualifies, and who repays, they just can't price risk with confidence. The likely outcome, for the first several years at least, a patchwork of loan structures, wide variation in interest rates, and significant differences from lender to lender, even for the same program, at the same school. And colleges are extremely concerned about this. Schools are also in unfamiliar territory here for a whole bunch of institutions, particularly those with high-cost graduate health programs classified under the lower borrowing cap. The new structure creates immediate gaps. The most contentious question is whether schools will engage in risk sharing, agreeing to take on some of the financial exposure if their students default on private loans. Most schools currently oppose the idea, but in private, several college administrators acknowledged that if enrollment falls sharply because students cannot qualify for private loans, resistance may weaken. Some schools have considered institutional loans, but few have capital large enough to replace Grad PLUS volumes. Others are exploring employer partnerships where an organization funds a portion of tuition in exchange for a work commitment after graduation. These arrangements resemble military or ROTC-style service agreements and could appeal in fields facing persistent workforce shortages. Industry groups are also exploring their own versions of the shared responsibility thing. It's kind of unclear, though, what form such a structure might even take, but the fact that associations are considering it signals how disruptive the new limits could actually be. Income share agreements, or ISAs, have fallen largely out of favor, and most schools just don't see them as a viable option. Private lenders have hinted at exploring income-driven repayment structures, but none appeared ready to announce a concrete product. Enrollment questions linger over everything. The most significant unknown is how students will respond. The truth is, there will be a cohort of students that won't qualify for any type of private loan and won't enroll in a graduate program. Programs where tuition far exceeds federal caps could face sharp enrollment drops if students fail to qualify for grad private loans. Even strong programs are going to see volatility as lenders experiment with underwriting models during the first few years. If enrollment falls too far, colleges may face some tough choices. Like lowering the price, for crying out loud, close programs altogether, consider the risk-sharing thing, or face complete shutdown. For lenders, student behavior also shapes risk. A massive drop in enrollment could jeopardize students in the existing program. Having to deal with transfers and changes could change repayment profiles, and without visibility into these patterns, lenders remain wary. Although, in the long run, could actually work out to lower the whole cost of tuition thing. But here's how future students can prepare for it. Borrowers entering programs after July 1st, 2026 will face a more complex, fragmented lending environment. Here are some steps to consider. Identify your program's CIP code to know whether it falls under the graduate or professional limit. The next thing you can do is request full cost of attendance projections, not just tuition. Make sure you say the words full cost of attendance. Also, just like shopping for a used car, you're going to have to shop various lenders. Expect private lending standards to vary widely. All kinds of lenders may offer different terms for the same program. You're going to need to get 3 to 5 quotes at least and compare your options. Also, ask schools whether employer partnerships or risk-sharing arrangements are planned. The common theme from lenders and schools is just uncertainty. Until data accumulates, the new graduate financing market will be a moving target. That is our show for today. I hope it was maybe kind of helpful to at least kind of think about these things for the future. If you want to learn more, find out more with all the resources that we have, it's inside this article at thecollegeinvestor.com. You can also find us all over social media. Search for the words The College Investor, and you'll find us. Thanks so much for stopping by today, and we'll talk to you again real soon.